We're looking at anywhere from the 500 to a billion daily by like in this quarter towards year end. We're already starting to see significant growth, especially on volatile days. Um, the other the other factor that we see is that a lot of the risk protocols that we baked into V2 itself has actually been you know very preventing forces like arbitrageurs from trading on our platform. So what you're seeing today with drift volume is almost pure 100% retail versus retail plus arbitrageur volume.
All right, we're live. Welcome to another episode of BidCast. I'm your host, Jason Cam, aka at Maple Leaf Cap. Today is July 1st, 2025, 4 p.m. Hong Kong time. BidCast is being live streamed to BidClub members. Questions are from the members and my own. This is not financial advice. Today I'm speaking with Cindy, the co-founder of Drift Protocol. Cindy, welcome.
Hey, Jason. Hey, everyone. Good to be here today.
Yeah, thanks for coming. We've known each other for a long time. I think people watching this probably know this already, but just to start, can you just give me a breakdown of the whole Drift business in terms of its trading volume today and how it kind of annualizes and bridges to revenue?
Absolutely. So Drift today does anywhere between 150 to 400 mil in daily trading volume. And to go even a step back, we're a leading perpetuals exchange built on Solana L1 with full cross-margin capabilities, multiple L1 native matching algorithm. We have over $1 billion in TVL. And one kind of lesser known fact is that we not only make trading fees on trading volume, on perps, we also offer spot. We offer borrow lend. We're currently the second biggest borrow lend. And as a result, the revenue of the platform is composed of perps trading fees, spot trading fees, as well as borrow lend fees. We take a percentage of interest rates. Right now, as an aggregate, we're annualizing about 25 to 35 million in annualized revenue.
Got it. And then a tick rate on the volume is like 3 bips, 4 bips, something like that?
On the major markets, it ranges from 0 to 10 bips. So BDC currently we're offering a 0 bips trading campaign. For the long tail, they are about a 10 bips take rate. And large percentage of our trading volume is within the majors, so Sol, ETH, BTC right now.
Got it. So I'm guessing it's like a 20 million type of run rate business with the perp, and then the 5 to 10 additional is from everything else.
Yep, that's right.
Got it. Okay, cool. And then is there any expenses in achieving this kind of revenue that we should think of?
So we don't offer direct token incentives. We did just wrap up our fuel trading campaign, which was an 8-month long trading campaign, kind of our second airdrop unofficially. We wrapped that up yesterday and emitted about, I think, 2% of total token supply within the last year. Unless you count an airdrop as a emissions or cost, we don't really consider it as such. We don't have ongoing trading programs right now, but yeah, this could change.
Got it. So aside from like labor costs, like that dollar 25 to 30 million falls straight to the bottom line.
Yeah,
got it.
That's right.
And then does it fall to token holders, or is there like an equity entity? Kind of walk me through kind of after you get that 25 million, where does it go?
So we have a pretty unique structure where we do not have any equity holders whatsoever. So every single person invested in or working with Drift are all token holders, and that creates that creates a much simpler incentive structure than structures where you have revenue flowing to equity. This also presents a much cleaner legal case for the cash flow flowing directly to the DAO. The DAO actually holds the all the revenues at the moment. As of now, the revenues are kept within the platform, held by the DAO, and used to provide liquidity for the platform. So this pot of capital is sitting there, increasing liquidity on the platform through depositing into the AMM, which creates a positive flywheel effect. In terms
Got it.
of value accrual, we our community put up a governance proposal just about a month ago that is pushing smart buybacks, where instead of regular buybacks that you know haven't proved extremely successful within crypto, the proposal that passed has a unique mechanism where it buys drift from the open market using protocol owned Treasury when it falls below a certain PE ratio. So it's always acquiring it at undervalued prices. This is actually what we would
Smart.
consider a much more sustainable mechanism to keep tokens being purchased back. And as of yesterday, it started to run in the open market.
Oh, is that right? And what's I guess the PE ratio is FDV on ARR
Yeah,
annualized?
yeah.
Okay. What's that ratio, if I may ask?
I will have to look more closely
Okay.
at the governance proposal. Yeah,
Yeah.
I'm also not on the foundation side, but yeah, happy to link it and have you take a look
Got it.
at what that proposal looks like.
Yeah. If it started yesterday, it's probably like 10, 15 times probably or something like that. Interesting. Interesting. And it obviously passed, I'm guessing, a month ago, you
It
said.
passed, yep.
Okay. Oh, very cool. And just for our interest, how big is the DAO treasury today from your history of all of the fees?
The Dow Jones is sitting at about 37 million today.
Got it.
Yeah.
Got it. Okay. Okay. Very cool.
Mhm.
Um, that's very cool. So moving on, I guess, historically, the perp decks went through many sort of iterations. You have, I mean, I don't have to count all the perp dexes, and then now we're standing at this stage with the future being quite exciting. There are shares coming in. There's like a bunch of Web2 companies coming in. There are like people saying L2 rollup is the future. I guess I want to break this down into a couple parts. The first question would be kind of standing at where you are today as kind of a largest, perp dex on Solana mainnet itself. What excites you the most in like the next 12 to 18 months in terms of business opportunity to grow and whatnot?
So I think the interesting thing is thinking about perp decks within a broader landscape. I think Robinhood has actually done a really good job at being able to contextualize what derivatives and margin trading looks like within a broader fintech business. And we've structured our business to date with obviously perps as the front and center, but on the back end, the fact that we are built on the L1 represents the biggest opportunity of all. And the reason that we say this and have always stuck to Solana as the home ground is that we believe that Solana will be the home of many off-chain assets and real-world assets, with the likes of equities, bonds, money markets, many forms of stablecoins, even native Bitcoin coming on chain. And having composability with those assets coming on chain offers very interesting and unique business cases. And one example for that for us is the growth of our vaults and spot product. Being built on the L1 itself means that we don't have to build a native bridge. We can rely on the full security of the L1, and we have composability opportunities with the spot assets coming on chain. So, imagine having a Bitcoin perp that's collateralized by a tokenized version of Tesla, or even tokenized private credit that's yielding, 10% annually. That's a true opportunity we see being built on Solana itself, because all these assets are already coming online on Solana. Unlike the isolated rollup situation, isolated L1s, they may have higher flexibility when it comes to their matching engines and what performance benefits that gives. but they lose out on a lot of the natural network effects that come from already being integrated within the L1. Um, so it's almost like inheriting a broader BD team and broader BD strategy versus like going out and building all of those cornerstones yourself. That said, the other part of the business that and growth that I'm very excited about is one of the biggest complaints about Drift and about Solana is that it is slower than our competitors like Hyperliquid, owing to the fact that we have been built on the Solana L1 and we've stayed very true to that thesis of we believe that L1 is the best way to go because of composability benefits. Um, now the criticism has been that it's a lot slower because we haven't had the flexibility that these isolated environments have had. I think this is changing very, very rapidly and in a way that the market doesn't realize yet. Um, with a couple of things. One is that the realization that liquidity on clubs is not the final form of liquidity in crypto. We're seeing the emergence of many different types of liquidity emerge. For instance, dark AMMs, where you have semi-opaque pools resembling dark pools in TradFi, where market makers are able to quote without being picked off as they would in a fully on-chain club. Um, and things like just-in-time liquidity, where you can actually put in a Dutch auction to resemble resting liquidity on chain. So I guess the summary of what I'm excited about is that we have chosen to be on the L1 for composability reasons. In the past, we've actually suffered in terms of performance trade-offs, but the performance trade-offs are now actually becoming more irrelevant as new innovations are coming up. And Solana L1 as a whole is improving to be able to meet this decentralized Nasdaq vision. So we actually see a lot of the stars aligning for perp decks on L1 making sense.
When you say perp decks on L1 making sense, you mean Solana itself is adding a lot of the speed and priority features that the rollups themselves are building. But
That's
is
right.
that anytime soon? Because if we have a year before this gets implemented, we could see a case where the perp volume will shift further towards the perp decks as they have their own L2s or L1s.
Yeah, I even think if you look at the rate of performance changes a year ago, even 6 months ago to now, and if you're an active user of these platforms, you would have noticed exponential increase in the performance on the L1 itself. There's also teams like Jito that we are working with to build trusted environments within the L1 itself to help with transaction ordering, for instance. And the Solana core team is working very closely on application specific sequencing that enables apps to enforce certain types of ordering. For instance, cancels first versus takers, and which enables market makers to have more confidence of being able to quote on the L1. These changes are in the order, in terms of timeline, in the order of magnitudes of months, not a year. And that's why
Okay.
we feel very bullish that this is probably the most confident that I've been in the underlying L1 technology.
Interesting. So we should see it before year end, basically, because I
Hmm.
think there are a bunch of them, like Lighter, and they're all coming live around that time. So I think
Hmm.
Sol needs to be ready. Okay,
Yeah.
and this is coming from Sol Foundation and the Anatoly himself.
Hmm.
Okay, that's very, very encouraging. And when you say that, it's just like effectively feature parity when it comes to latency, as well as kind of order priority and those kind of things.
Yep. And
Do,
there's a lot of things that we're doing as well on the app to make sure that this all comes together well, which includes, and we can talk about this in a bit, but
yeah.
launching our own version of JLP and HLP, DLP, all wrapped together in a big upgrade coming in August. So, a big timeline for us is like we understand competition is heating up. We're not kidding ourselves when it's like every single day there's a new perp dex popping up. But if anything, the graveyard of perp dexes out there will show is that it's very easy for mercenary liquidity to come and go, right? And for the platforms that have continued to survive and continue to actually grow in this time period, we believe that there's a big spot for them to continue existing post this.
And if I'm not mistaken, excuse me, the RFQ is currently the main volume driver for your 150 to $400 million today. Is that correct? Go ahead.
So actually the AMM has grown a lot in the past few months, as the AMM has improved in its tightening and quoting mechanism. We're starting to see AMM be up to 40 to 50% of the fills. At the same time, liquidity has grown substantially on the resting order book, as well as just-in-time RFQ side as well. So the majority
So
used to be,
mix.
it's a pretty even mix today.
Oh, wow. And I guess when these updates come online, because the peers are like sub 200 milliseconds, sometimes there's like a priority, like cancel is takes priority. There's like a bunch of stuff they're talking about. After the upgrades that totally promise comes online, do you expect the mix that you'll have to be materially different?
That's a good question. I do think that there will be an increase in active liquidity, so just in time and in order book. But this is hard to say at the end of the day because with DLP coming live, which is adding more liquidity to the AMM side as well, if DLP has reached a substantial TVL, which we believe with the yields coming from the platform, it can the AMM could actually see growing traction too. So we're kind of, and the reason that we built a system with multiple liquidity providers initially was, okay, we understood that clubs as a whole and as a standalone cannot be as competitive on the L1, at least in the way that it was designed before. Historically. But what we've also seen with spot markets on Ethereum and even Ethereum L2s is that AMMs still continue to dominate on many markets, right? We haven't really seen a full club spot exchange yet. That's why we believe that we haven't really seen the final form of what an exchange on chain looks like yet, which is why we're making the bet that it could be multiple things. It could be a really, really strong EMM that has great matching engine and logic. It could be a really smart market maker that knows how to RFQ like with full precision, or it could be a market making team that is able to quote the best on chain once the L1 technology improves. So one mental model to think about it is the better Solana underlying technology gets, the better the active liquidity gets. But even without, the AMM logic itself should continue to improve over time, whether or not the underlying infrastructure is there. So we were kind of future proofing our business to be able to win in any of these situations.
Do you feel like once the upgrades do come due, you would, I don't know how technically feasible it is, but also having Clop be a part of the liquidity offer, like, are you planning that? Is that something you have in mind?
So we launched an upgrade to our system in about February this year. It was called Swift Protocol. What Swift Protocol is a way for traders to connect directly with market makers using a technology called sign transaction on Solana. So it bypasses the need for the transaction to place the order to be fully confirmed on the L1. Now, what this means is it cuts down the latency of you placing an order direct to the market makers, where the market makers can actually read your order from the server, bundle that order together with their approval for putting liquidity, and then have that as a single transaction on chain. So what this means for the user is that it's completely gasless because you're just signing a transaction saying that you allow a market maker to fill you at this price within a certain slippage band. And for the market maker, they get instant access to the user order flow. And this is happening on what we call a market maker channel that almost exists on top of the blockchain. It doesn't need, and the market maker is the one that bundles this and puts it back on chain. So everything is still fully on chain. Users still have to sign the transaction, but we've seen that this actually cuts down the transaction time by over two 3x, because now you've cut down the layer where user needs to place an order on chain, market maker needs to place an order on chain, and then a keeper needs to match those orders together. So this Swift protocol can be extended to actually build a club itself as well, because then you can insert club logic where thinking about it as like I don't want to use the word roll up, but it's a channel that exists on top. Right now it's for Dutch auctions, but that concept can easily be extended to be applicable to clubs as well. Yeah, that is going to be longer term play, more medium term. And we're confident that we want to see how this like DLP, AMM, and as well as JIT version rolls out as well. But the market continues to show its hand that clubs are the way to go. We do have the infrastructure in place to ship and launch that.
Got it, but that's like I guess it'll be like it's not a roll up. It's like a centralized layer on top that the users kind of choose to, although they kind of choose to trust the other exchange because the end result is the same. It's extremely fast latency confirm on the user end, but the logic doesn't get implemented. The user chooses to trust exchange to execute, kind of.
Well, the user would still specify their own parameters for order filling. So the order would fail if it surpasses the user, expectations. So because the user signs the transaction initially, you couldn't rug the user and say, hey, I'm going to fill you like $10 like above where you had specified your order to be. So there's still the security inherently baked within this protocol that is contained within that order. You could still see everything that goes through. The only thing is we're cutting down the parts where it doesn't have to be fully on chain, which is the parts that create latency.
Got it. So you're not launching L2 anytime soon. You may implement club logic on your centralized design later on, but for now you're relying on the Solana and mainnet upgrade alongside with your sort of hybrid model to provide liquidity for both perps and spot. And
Correct.
Do you feel like that's why your volume kind of lags the few guys that kind of really ramped up historically? And do you feel like the market share situation would reverse once you're kind of at feature parity in some of the key products?
I think so. And I think the reality is a couple of things. One is that in the last year, we, after launching V2 and after seeing good growth post our token launch, we started to build out, our product stack, which is our earn product, our vaults product, even prediction markets, and we spent a lot of time building out tangential orthogonal products that serve to grow the pie. And the reason that we did this was one, these products still make a lot of sense from a growth perspective. And we saw ourselves filling the gap of being a super protocol where you could do anything within a single execution environment. That said, because of our focus on these new products, we spent less time honing and fine-tuning and being laser focused on perps itself. And I would say that this focus internally has shifted back to perps. As these other products have already, started to mature, have reached a level of PMF, we see it prudent to actually go back to the main perps product now, and that started with our Swift launch earlier this year, which pushed trading at the top of our minds. And so, I would say yes, the product has suffered when it comes to these new entrants. A lot of our product suite was built at a time where some of these, optimized user experience tools were not live yet. For instance, Privy wasn't a thing when we built Drift back in 2022, right? And we had to figure out a lot of the building blocks ourselves back in 2022 when today a lot of things exist to optimize things like further. So we're working on a big product overhaul, which we will be launching in August, that essentially modernizes a lot of the Drift functionalities to match feature parity in terms of onboarding speeds, in terms of time to trading, in terms of social logins, to match what's out there in the market. So TLDR is, we've been live for a very long time. A lot of our infrastructure still comes from a time where these optimizations didn't exist. And now we're wrapping all of these upgrades together alongside DLP, the work that we're doing with Jito to improve execution times on chain, as well as Solana Foundation, and wrapping that into a revamped product in August. So even from now until then, you should continue to see a lot of huge upgrades. And we see that to be a strong inflection point for volume coming back to our platform. And winning back traders who might have been frustrated with liquidity before.
That's very cool. I didn't know that. So and you mean it's live in August, and at that point, what we should be seeing is an HLP equivalent type depositing experience that provides depth, but also basically you're segmenting the execution versus the transaction, kind of placing of orders. So it's extremely fast, UI UX wise. But the fill should actually get tighter also based on all your designs. That's cool.
That's right.
And so it's great that you're reaching feature parity on the perp side. And as an extension to that, the users kind of are already trading somewhere. What kind of go-to-market steps have you done to basically grab them and stop trading on XYZ lighter or whatever and come to us? What are the incentives? What have you done? And then second part to that is after August into year end, do you have a kind of a monthly volume, daily volume target for yourself with this revamp?
Absolutely. We're looking at anywhere from the 500 to a billion daily by in this quarter towards year end. We're already starting to see significant growth, especially on volatile days. The other factor that we see is that a lot of the risk protocols that we baked into V2 itself has actually been very preventing forces like arbitrageurs from trading on our platform. So what you're seeing today with Drift volume is almost pure 100% retail versus retail plus arbitrageur volume. And that is actually the source of a lot of the discrepancy that we see between our exchange and others. If you compare DAUs and actual retail volume from smaller accounts, you would see that the organic volume is actually very similar to our competitors. The only thing is that we've dialed up a lot of the risk on the platform. Risk controls on the platform, preventing arbitrageur type of trades that could increase the risk of unnecessary liquidations or bad debt on the platform. So this is something that was kind of baked into the initial risk considerations. But obviously this is something to consider as well in terms of with the launch of DLP, we actually make the exchange safer by having external sources of liquidity being plugged in, which allows it then to be able to take larger risk instead of being purely on protocol AMMs. So this helps to both increase the yield on DLP as well as allows the platform to take bigger risk, enabling arbitrageurs and more high frequency takers to come in. I think this is going to be a big unlock for us too.
And that means you have your target set on maybe 80 to 90, even 100 million. You'll basically be on par with Jupe and maybe even above them.
Yeah.
Is that the right math that I'm doing in my mind?
Yeah, that's right.
That's cool. I mean, the token should obviously reflect it. if you do achieve it. What's the biggest hurdle you think in this kind of outreach journey of getting people to trade back on your platform? The feedback and those kind of things.
Yeah, I think that owing to us having been live for so long, we've been constantly, reinventing ourselves when it comes to keeping up with market demand and obviously doing this fine balance of okay, we have a problem of achieving certain types of liquidity on chain because of the design decisions that we've made, um, fixing that, and then kind of like having secondary issues come up from that, whether it comes from like a risk perspective or any sort of like design perspective. So I think a lot of the challenge has actually been battling these trade-offs over the past like couple of years, and we've made a lot of progress on many different fronts. But it's been difficult to send the message of like, hey, come back as we've made these like iterative changes. The reality is that building on an L1 is just infinitely more challenging than building an L2 or building a new environment on our own. I think it's a
Mm.
long game and it's a right game to play, which is why we're still in the trenches and we're still continuing to go at full force with what we're doing with full conviction. But it is more challenging. There are a lot of things that are not necessarily within our control. Um, but we do believe that a large majority of users want to keep their assets in a place where in an L1 that they trust. And that's why we are the highest TVL perp dex, right? Like people trust open source Solana smart contracts. People trust the L1 that it's built on, and that's the design philosophy that we're gonna keep on iterating with. The difficulty, of course, is like as we're making these iterative changes, we might lose users over time, but I do believe that we're at a turning point now where these changes are slowly all going to be reflected in performance and in feature parity. And this is the most confident I've been in the last few years of running Drift that I think that the stars are finally aligning.
Oh wow. Okay. So the network finally got good enough, basically. Like you're solving all of
Mhm.
these onboarding issues. That's cool.
Yep.
Um, I mean, the market's pretty noisy with all of these, crazy things that's happening. Like you can maybe like you can trade crypto now on iPhone. You
Mm.
can like trade stocks. You can offer perps on like stocks. Like people are going, really aggressively into RWA. I guess in terms of the instruments or a lot of the perp that you have talked about is like blocking and tackling, like growth. But like, is there anything on the feature side that one second. Is there anything on the feature side that kind of really excites you, or kind of the instruments you can trade that you feel like could
Mm.
push you to the next leg of growth? Maybe even beyond half a billion to a billion.
Yeah. So I do think that real assets are a big part of this. I think that stocks coming on chain and even having equity perps, we've seen some of this start to take off in other ecosystems. We haven't really seen that in Solana yet. I do think that this is a big way for us to increase our volume. Even going as far as adding commodities or FX on chain. I think there's a big market to trade these things during obviously like wartime period. Everyone is a macro expert and they want to trade crude oil. They want to trade equity indexes. So I do think that having these things coexist within one platform where you can trade stock perps alongside Bitcoin, alongside Sol, um, is a very good environment for bringing net new volume in. The other thing and the other growth lever we see is really vaults. Um, Having, a trusted fund manager be able to manage your risk on behalf of you is represents a very big source of alpha because it means that anybody can now deposit into professionally run hedge funds that you don't need to meet a certain like 100K minimum. And these vaults are all doing volume. They're all running strategies that um, regular people, if they don't have that trading or prop trading experience, like would be able to run on their own. So I do think that there's a big opportunity for these type of for these vaults. And we're currently already the largest structured product on Solana. To see more iterations of these type of strategy vaults.
Got it. Aside from what we've talked about, I guess we touched on the sort of potential growth of the exchange with reaching feature parity and grabbing the folks that left Solana to come back. Is there anything else that, I guess after you push August, there are some additional blocks and tackles you have to do, but like, what's the roadmap for next year? Or like, what's the next kind of big thing for you once you have solved this?
So one of the launches that we did during Drift DeFi Day about a month ago was Drift Institutional. So we launched a institutional product with Apollo and Securitize, where you can use you can now trade Apollo's private credit fund on chain directly. You can also run levered looping strategies using Apollo's private credit fund as collateral. This is pretty net new in terms of what has been like what DeFi is capable of. And that actually makes me very, very excited for where this could go. Obviously, there's a lot of blockers today with actually acquiring this token itself. It's similar to stablecoin minting, where you need to be KYC to mint, and then you basically get a staked version of it that you can trade freely on chain. Now, I don't think the market appreciates how crazy it is that you can hold on to a tokenized share of a previously fully illiquid asset that didn't have a representation anywhere liquid, borrow stable coins against it, and use that to mint even more and run that trade again. That basically increases your total yield when you do the loop and count for borrowing costs from like 8% to 14, 15%. And this is just one example of a type of real asset that's been enabled, given utility by DeFi core mechanisms. And these are the sort of longer term, medium term innovations that I see us continuing to draw on as we become a full suite DeFi prime brokerage type of service. But yeah, I do think there's a bigger vision there with more and more of these types of assets coming on chain. Obviously, medium term focus is we want to win the perps market first. And in the meantime, build up all of these 10 orthogonal businesses to continue to capture growth, even though that is more of an experiment, given that these are like largely net new.
Should we expect more of those kind of products come online as part of your collateral? I guess that can be traded and borrow against.
Yep, we're continuing to work with a lot of the larger financial institutions that want to tokenize fund products. And the very interesting thing is that crypto is a pretty sizable industry in terms of total wealth and total GDP, and to the point where these financial institutions are see it as a very viable place to bring their assets to. It's almost as if it's like wealth management businesses finally see the crypto market as something serious to go after, and attracting like stablecoin flows, attracting these markets. And so we're kind of seeing the reverse of what's been happening. It's like TradFi is offering its products to crypto native users, to crypto native foundations, high net worth individuals today. And those users have a very unique risk profile of not caring or, well, being very aware of smart contract risk in DeFi, in a way that, a person who's never interacted with crypto before just doesn't understand. So I do think that those confluences coming together means that all of financial institutions are clamoring to bring products like this on chain, because you can actually see huge growth.
Do they have to deal with you? Like, I'm curious how you won that deal, because it sounds like something that would be on, I don't know, like Plume or on like that's what they talk about. But what's the revenue contribution for that product to Drift today? Like, how did you win it? And yeah.
So that's also part of the reason that we believe being on Solana L1 is superior, because that product came to Solana L1, right? In terms of being tokenized, Solana already has all the token standards in place. Uh, Apollo's not really getting tokenized on a random L2 somewhere, right? From a native perspective. So by being on L1 itself, we're positioning ourselves to receive all of these tokens, all like by nature of how we're designed. The X stocks that were just launched yesterday, all live on Solana, right? So like I said, it's a layer of work that we benefit from just by being on this chain. So with that, we're able to accept this as collateral, which is pretty mind blowing.
And collateral for perp trading?
That's right. Yeah.
But the customer is already a KYC customer for perp trading, I'm guessing.
Yeah.
Got it. Or I guess if I'm not KYC ML, I can purchase this. I can use this as collateral.
Yeah.
Okay. Interesting. How fast do you think this blows up into the next couple of months? Because I do have like a massive pipeline of things to be tokenized, and it's like yeah.
I think there's different styles of assets. I think the slow assets are the ones that are like private credit. It's like they're all kind of like yield games. There's gonna be like private credit that comes from different institutions, different styles of like how exotic do you want the private credit token to be? Are you willing to face a higher liquidation or default risk if you take like 20%? And then if you want to go even deeper into the granular parts, it's like, is there a style? Is there like a portfolio of different like private credit assets from different issuers that you want to take and combine that together into one versus just be having like a flagship one. So there's a lot of customization out there. Fundamentally, it just flows into two buckets, which are slow moving and then fast moving assets that have high velocity. I think for slow moving, you're really just competing on yield. And we're starting to see more and more like exotic type of private credit like coming on chain. And then on the fast moving side, we're starting to see a lot of different types of tokenized equities coming on chain. I mean, I see like for instance, Robinhood launched private stocks yesterday. Imagine being able to trade OpenAI on chain, right? Based on an oracle that ties to its latest valuation or its latest secondary valuation that's weighted by liquidity somehow. That to me is a very interesting opportunity to be able to bring both crypto native investors the opportunity to hold on to these types of assets. So and then going even a step further, it's like if you're really trying to build a decentralized NASDAQ, decentralized CME, I think all of these things have to exist on the same plane. So being able to trade like OpenAI for Bitcoin or being able to trade that for Sol, even like use that to build a CDP type of position and then launch your own stablecoin from OpenAI stock. Like that's the beauty of DeFi ultimately. I don't think it's from isolating yourself. It's from sharing in the broader execution environment.
Do you feel like a KYC ML is a big enough hurdle to prevent the users from using these kind of call it innovation that happens on chain on Solana?
Is KYC a hurdle?
Yeah,
Is that your question?
I get your point about being composable with all of these assets coming on chain is like
Yeah.
pretty exciting because you just don't know which one people want, and if they do want it, and you're the only venue where they can use it as collateral, people are going to use it, and you can't do that on Hyperliquid, for example, not yet. And therefore, if that's a really hot instrument, then that's the hook to suck up all the volume. But if the downside for that is one has to KYC ML, then the dude that apes millions would just like pause for a second. Do you feel like that's a hurdle, or do you feel like there are kind of looser actors that kind of really just went at it and does not need KYC ML, you can ape these kind of things and you will still accept it as collateral?
So the X stocks that just launched yesterday has the same mechanism in terms of KYC ML as stablecoins, where
Mm.
you need to be KYC to mint and provide liquidity for them. And this is usually the role of MMs, right? Who kind of take that mint and redeem risk, and
Yeah.
then from there, it actually is a permissionless asset. So you don't need to be KYC to touch them on chain. You do need to be KYC to redeem them. So ultimately, you are relying on the KYC of the liquidity provider on both sides. Just similar to stablecoins, you're trusting that bridge exists. But you still have a very seamless experience. Yeah.
Yeah, that's fascinating because it's almost like a loophole. Because stablecoin is just dollars; it's not a security. But this is clearly a security that kind of
Yeah.
is out of the ring fence. I don't know. Like at some point, SEC is going to come on and just like, whoosh, but
Yeah.
not today, I guess. Interesting. Do you expect that to be a separate business line for you that contributes revenue, or I guess it manifests itself in TVL and lending borrowing volume? Or I
Mm.
guess because of that, you should be able to grow TVL faster. It seems like you've highlighted the institutional side and the asset RWA side of Solana being a key competitive advantage. I guess it just helps you grab the customers faster, right? But not necessarily as directly as a business line in and of itself.
Yeah, we will make money on the borrow lend side of things, so like a percentage of borrow and supply spreads.
Mm.
Um, and then with the vault product, we've taken zero fees on that, for instance. But given that we've helped many businesses start from scratch, and avoid the operating costs of running like a hedge fund business, that could take a percentage of the management fees charged per vault, for instance. So these things are zero fees today, but
Mm.
you could very easily imagine revenue being charged on this as a launch your own hedge fund business, launch your own trading strategy business. We wanted to ensure that it grows first and see initial PMF on it before charging on it. But I do think that there are simple ways to monetize on this flow. Of course, today we
Mm.
care more about growth than monetizing on those aspects.
Got it. Last couple questions for me. I guess do you plan to give out a lot more token incentives on the pending August launch of your new features and products?
Yeah, the plan is to do token incentives then. We're, obviously having a broader conversation with our community on the best style
Mm.
that makes sense. I think that token incentives, at least ongoing token incentives from a trading perspective, is a problem that hasn't necessarily been cracked yet in a sustainable way. So we do want to be careful with how it's done because you obviously want to avoid wash trading. You want to make sure that it's also seen as an exciting way for people to get rewarded. So yes, the short answer is yes. Long answer is in terms of the how. Ongoing conversation on what fits our needs and the community wants in the best way.
Mm. And then I guess the expenses of salaries and growth and all these other expenses comes out of the DAO Treasury. The team doesn't have to sell tokens to fund itself.
So the right now it's happening on the labs entity, which did fundraise in the past, and then as an ongoing, more and more of the business will be moved to the foundation side, where the foundation then can fund the expenses of that. But right now, it's actually borne by the labs entity.
Got it. And the labs itself is does not need to sell token to fund the expenses.
No, not right now.
Okay, got it. Makes sense. Um, Let me see. Is there an inflation rate you target annually for token incentives to kind of grow your platform?
Um, There is no specific target right now. We had budgeted for something like say 5% annually in the initial token launch. This is not a
Yep.
strict number, but that's the rough amount that we had in mind.
Got it. Got it. Got it. Very
Yeah.
cool. Let me see if the group has any other questions. Is there anything we haven't covered yet? I think the GTM and getting people back upon your future launches would be crucial. I mean, good luck with that. I think it'll be a really kind of exciting time into the second half of the year, just because there are a lot of features that will be added and a lot of products that could come online. And if you hit your target, I mean, if you hit 90 million of ARR with a PE-based buyback, the token should do quite well versus what it is today. It's like a 4 times, 5 times earnings. Is there anything we haven't covered you feel like we should cover on the back of this?
I think we went through quite a bit. Yeah, I would just say, what we're gonna spend a lot of time slowly revealing DLP launch. So if there's any early feedback that the market wants to give, or anyone wants to test out DLP with us, very happy to give you guys a first look. We also are gonna be talking a lot about what we're doing on the Solana core side in more detail. Obviously, I didn't really go into super specifics there, but more and more is gonna come out on that in the coming month.
Solana core, so you
Yeah,
can't talk about it or right now.
yeah, yeah.
Okay.
Let's do it right
Okay.
now. But
Okay.
um,
Fair enough.
mhm.
Okay, great. Well, Cindy, thank you so much for your time. I really appreciate you coming on. This has been quite helpful learning about the future roadmap.
Thanks so much, Jason.
Thank you.